So, good afternoon, Sir Pai, and we are the group one, and we are about to report the uncovering corporate fraud and analyzing financial statement fraud. I am Nesil L. Dumalagan.
I am Grace Abarquez.
I am Ariane Abuton.
I am Vienna Adaro.
I am Darilyn Amaro.
And I am Lady Jean Babaw.
Prevention and Detection Awareness for the Fraud Audit. So, employee fraud is a significant problem faced by many organizations of all types, sizes, locations, and industries. So, why we would all like to believe our employees are loyal and working for the benefit of the organization, and most of them probably are. There are still many reasons why your employees may commit fraud and several ways in which they might do it. So in this topic, we will going to tackle about the six strategies and how to prevent fraud in the organizations. Okay, to begin with, we are going to have the number one strategy, which is organizations must know their employees. So organizations must know their employees. So, for fraud perpetrators often display behavioral traits that can indicate the intention to commit fraud. So, observing and listening to employees can help you identify potential fraud risks. So, it is very important to the management to be involved with their employees and take time to get to know them. And the next is make employees aware or set up reporting system. So awareness affects all employees. So everyone within the organization should be aware of the fraud risk policy, including types of fraud and the consequences associated with them. So those who are planning to commit fraud will know that management is watching and will hopefully be deterred by this. And the next strategy will be implement internal controls. So, internal controls are the plans or programs implemented to safeguard your company's assets, ensure the integrity of its accounting records, and deter and detect fraud and theft. And the next strategy will be monitor vacation balances. So, organizations might be impressed by the employees who haven't missed a day or of work in years. So, while this may sound like loyal employees, it could be a sign that these employees have something to hide and are worried that someone will detect their fraud if they were out of the office for some time. So, this may also reveal fraudulent activity as it allows a second employee to review the activities of the first. And the next strategy will be hire trustworthy experts. So many of the people working for your company, including the CFE or the certified fraud examiners, the CPAs who are certified in fraud forensics and can all play important roles in establishing anti-fraud policies and procedures. So, however, not all of these experts have the experience or the reputation for providing the service that is best for your needs. When hiring accountants, fraud examiners, and other experts, professionals who will have access to sensitive company information, such as bank account members, it is critical to ensure these firms or individuals have reputations built on quality, service, and trustworthiness. So, and the next strategy will be the leave the corporate culture. So, a positive work environment can prevent employee fraud and theft. There should be a clear organizational structure, written policies and procedures, and fair employment practices. So, and that's all for the prevention of the fraud. And the next is will be the detection. So, in fraud detection, in addition to prevent strategies, you should the organization should also have detection methods in place and make them visible to the employees. So Hindsight or looking back is a wonderful thing. Fraud is always obvious to the fraudsters' colleagues after the event. So their statements and those of internal auditors, when taken by the police or other investigatory bodies, frequently highlight all the more common fraud indicators. So, as you can see in the picture, the external auditors do not generally find fraud. Although the external auditors do not detect many cases of fraud, internal auditors, on the other hand, were found to be the most successful in identifying serious frauds. So, risk management procedures were also found to be one of the more useful methods if resources will allow it. So, who is responsible for the prevention and detection of fraud? It's the audit's problem. So fraud indicators fall into two categories. It will be the warning signs and fraud alerts. Warning signs have been described as organizational indicators of fraud risk, and some examples are set out below. Um, for convenience, these have been subdivided into business risk, financial risk, environmental risk, and IT and data risk. So, next is the fraud alerts. So, fraud alerts have been described as specific events or red flags, which may be indicative of fraud. A list of possible fraud alerts is provided by the next reporter. And the next is uniform occupational fraud classifications. So, occupational frauds are those in which manager, officer, or owner of an organization commits fraud to the detriment of that organization. So, there are three major types of occupational fraud, and these are the corruption, asset misappropriation, and the third is the financial statement fraud. So, in corruption, this is a scheme in which an employee misuses his or her influence on business transaction in a way that it violates his or her duty to the employer in order to gain a direct or indirect benefit. And the asset misappropriation, it is a scheme in which an employee steals or misuses the employing organization's resources. And the last, financial statement fraud, it is a scheme in which an employee intentionally causes a misstatement or omission of material information in the organization's financial reports. And this under of the corruption is the conflicts of interest, bribery, illegal gratuities, and economic extortion, and so on and so forth, and the asset misappropriation and financial statement fraud. So under the asset misappropriation, there is cash and inventory and all other assets. So in cash, there is theft of cash on hand. So it is a scheme in which the perpetrator misappropriates cash kept in hand at the victim's organization's premises. And inventory and all other assets. It is a scheme in which an employee steals or misuses non-cash assets of the victim organizations. And the next will be the distinguish or the difference between high and low fraud environment. High risk fraud environment, usually organizations that has a low level of their internal control and they have low managerial aspects. And when it comes to implementation of their organization's policies are lenient. And because of that, it will give opportunity to those in the higher positions to commit greater fraudulent activities because they neglect the minor ones. So because the management tolerate nila ang mga gagmay lang mga fraud activities. That's why ang gagmay mahimo na siyang dako. So and gi-implement nila ang ilahang policies nga kanang easy ra kayo balinyan ra kaayo. So that's why it is a high risk fraud environment. And like sa low fraud environment is the opposite of the high risk environment. And that's all for this topic. And the next will be the other environmental red flag to be reported by Miss Adaro.
So, what are the other environmental red flags? Fraud red flags refers to undesirable situation or conditions that consistent contribute to fraud, waste, and abuse of resources. When an investigator is reviewing a company's stock or financial statements, certain undesirable characteristics may stand out as fraud red flags. Contributors to fraud or circumstances that may indicate the presence of fraud. All organizations face fraud risk, which can be either be internal or external. Internal risks come from persons within the organization who use their position to enrich themselves by misappropriating resources and assets owned by their employer. External risks are engineered by government officers, customers, and contractors who may seek to obtain their money legally. There are red flag warnings as fraud. There are several red flags that audit and accounting professionals should look out for. So they include the following. Number one, inventory shrinkage. Although it's not normal to lose a few items of inventory when moving items, excessive inventory shrinkage may be an indicator of an ongoing fraud. An auditor can detect inventory shrinkage by looking at the balance sheet, the number of products in stock and those sold, and then comparing them with previous records and projections. In certain circumstances, the auditor may do unplanned stock taking on random days to detect any unusual inventory characteristics. Next will be missing documents. An organization may experience frequent cases of reported missing documents that related to critical departments. When the frequency of occurrence becomes too often, it may be a sign of ongoing fraud within the organization. Missing documents that are fraud red flags include registration of motor vehicles, list of sales and purchases, checkbox, and inventory reports. When such records disappear, it may point to an undesirable situation that leads to lose or insert certain assets or money. Next one will be multiple payments. There are cases when a company's accounting department or erroneously process duplicate payments to a vendor or service provider. If the mistake was genuine, the officers involved ought to identify such errors and report so that urgent action will be taken. However, there can be cases where individual employees endorse duplicate payments to both genuine or fake companies. Some employees may even process payments to non-existent companies with the intention of defrauding their employer. To prevent such errors, all payments should be monitored and verified that they are going to be intended parties. Next one will be spikes in invoice volume. A business in its growing phase may experience huge spikes in the number of invoices that as it tries to carve a niche in a company. However, the high number of invoices creates room for fraud behaviors as specific internal and external parties may seek to profit from the rapid growth of the business. For example, there can be cases of unrecorded payments, or if they are recorded, they are understated in volume and amount. The organization should know when spikes occurs or ensure all orders made by customers are recorded and fulfilled on a timely basis. Now, next, frequent complaints. Frequent complaints about certain personnel or processes may be an indicator of fraud. When an organization receives repeated complaints about a senior executive, should not assume that it's just ordinary venting. Instead, it should conduct investigation to identify the cause of complainants, effects, and any courses of action that they should take in to make sure there are no more complaints. Also, may report frequent underpacking of products, where the products delivered to them are less than they ordered. The organization should investigate whether this is a deliberate action by the sales department or a problem with the packing department. Next will be excessive number of adjusting entries. Some accounting offices may take excessive adjusting entries in the books of accounts as a way of covering money misappropriated in the past. For example, some of these adjustments may include customers' adjustments that significantly affect the financial results during a specific period. Making excessive adjustments without particular reasons point to cases of employee fraud with the intention of hiding certain transactions. Any adjusting entries in the financial accounts should be accompanied by corresponding notes or explaining the reason for the adjustment. Next, there are also employees' fraud red flag, which is a large proportion of fraud affecting organizations comes from within the organization itself, mainly from employees. Some of the behavioral signs of employee fraud include number 1, lifestyle changes. Number 2, history of debts, and next, excessive gambling. Lifestyle changes employees ought to live within their means by buying assets and services that are within their income. However, some employees may change their lifestyle by spending more than their paycheck allows. The purchases can be expensive cars, houses, or luxury goods. Sometimes, the employee's lifestyle may exceed their superior. Any improvements in the employee's lifestyle without a proportionate increase in their income should be investigated to see if there is a probability that the individual is involved in a fraud. Next, history of debt. During the hiring process, an organization should conduct background checks to see if potential employees have a history of debt. When a company has employees with debt problems, there is a likelihood that they will find opportunities to get extra income above their salary to pay debt. It may mean engaging in opportunistic fraud with the intention of obtaining money that they are not entitled to. Last will excessive gambling. Some employees may continuously engage in gambling as a way of getting quick cash to meet some of their needs. Due to the addictive nature of gambling, the employee's income may be insufficient to finance their gambling activities, and they may feel forced to do anything to earn extra money. This may mean engaging in fraud activities such as stealing the organization assets, manipulating inventory, making extraordinary claims, or etc. Identifying employees involved in gambling and help them get out of the behavior can help the company reduce incidents of fraud. To take away these fraud red flags, every organization, including those gent rules, are seek for fraud. To prevent fraud from happening, organization must first acknowledge that fraud exists and create awareness among the stakeholders. Organizations should start by training their employees on how to detect fraud at work. They should also implement policies and procedures that will help them seal the loopholes used by fraudsters to conduct their activities. The next topic will be telltale signs of fraud in a company or in organization. Fraud is an increasing enterprise risk, but many organizations don't notice the early warnings that the problem exists. All organizations are susceptible to this risk. We can safely assume that be in any industry, the warning signs are often the same. Awareness of the sign and a sound approach to encountering them can often deter many opportunistic incidents of fraud. Number one will be volatile reporting. This sign is just as applicable to suppliers and contractors as it is to internal departments and functions within the organization. Incomplete, late, or excuse-laden management reporting is often a classic sign that something is wrong. To solution with this, you should insist on up-to-date reporting with a set of timetable and then build this into an internal GRS or governance risk and compliance. It will be help a company to solve the problem. Adapting to new technology will help the company prevent such risks. Number two, process loopholes. A weak security system is a result of ignorance over time. It is a common occurrence, especially when things get busy. When precaution and risk avoidance measures get bypassed or ignored, there is a high risk of non-compliance. With the right processes in place, top-level management are often into a false sense of security that they are actually being used, while the fraudster is busy at work getting around them. To solution this, you should make sure that you implemented the suggestion of your internal compliance manager and organize appropriate training to reinforce attitude and practice. Ensure that the control processes, especially in tendering, purchasing, invoicing, and customer controls and identification are always kept strong. Next, data dumping. A major indicator can be the act of deletion or pressure on staff to delete, remove, or otherwise dump past records following a restructure, a new division launch, or acquisition. It will be an even bigger problem where internationally operations are involved, as it's far harder to find or recreate evidence in a foreign territory. To prevent this, you should take care to establish and log where paper documents are and when they should be not to be stored. Identify who is in control of the system processes and who is responsible for and has ownership of the records. They are not always the same person, of course, kay isod po dog parihara tanan. Dayon, you should ensure that scanning and indexing works properly and that no one can intercept or edit documents. Also, you should ensure that storage capacity is enough and controlled properly. Next one will be inconsistent data. Whether it is archived data or cross-reference checks that are missing or wrong. Factual inconsistencies will also occur naturally. The chiefs who seek to defraud an organization will use the possibility to explain such inconsistencies and hide their fraud. To prevent this, you should ensure that no one has the access to any files. Internal or external auditors should sample check their case files from time to time as part of the audit program. Next one will be delays and audit. Excuses, confusion, or wild goose chases when disclosing to auditors. Be they internal or external can be telltale sign too. We need to remember though that the audit team is not there to find fraud. Rather than that, you should ensure that the correct processes are in place that will deliver appropriate protection. To prevent also this, we should ensure that everyone treats audits as important and make sure that they are complete on time and properly, and with appropriate audit skills. Where there have been delays or difficulties, investigate why this was the case by drilling down into the detail. Make sure that the business critical and financial exposure areas take a priority and act upon all failings both quickly and completely. With follow-up, audit is necessary. Next one will be abnormal behavior. This can range from acute defensiveness and resistance to attending review meetings through to blaming strategies or even aggression when specific questions are asked about processes or figures. Solution will be you should train the HR department to spot fraud employees. Then, if you still have concerns about such people upon closer inspection, all the relevant files need to be pulled and checked, or you might even consider a private investigator to look deeper into the process used by such high-risk people. Next one will be grapevine. Staff whispers and rumors should always be taken seriously. These are, however, you should often overlooked by senior management. The action you should do will be you should listen, take all such rumors seriously and investigate the reality. The last one will be fishy independent personnel. Good non-executives provide unconsidered, independent and external perspective. Often they bring in specific expertise from outside the board's immediately experience, and their skill can vary from financial knowledge through to IT. The solution will be it is always good for the business to maintain a fresh supply of new thinking, new approaches, and new concerns. Thus, if non-executives have concerns about particular issues, one should fund their thinking by allowing them to bring in the appropriate specialist experts that can investigate matters more deeply. And the next topic will be followed by my co-reporter.
So I am Nesil Dumalagan and I will be reporting about the analyzing financial statement fraud. First topic is to interpreting financial statements using ratio analysis. There are several ratio analyses and I will be tackling three of that. So there are various techniques and ratios to analyze a set of financial statements. On the other hand, there are various techniques used to report financial statements fraudulently, such as overstate revenues, understate expenses, understate liabilities, overstate assets, and or improperly disclosed information by unethical management. So the first one is the evaluating liquidity. Evaluating liquidity or the liquidity ratios measures a company's ability to pay off its short-term debts as they become due using the company's current or quick assets. So there are three specifically there are three. The current ratio, there are four rather. Current ratio, asset test ratio, receivable turnover, inventory turnover. So first one is the current ratio. It is also called as the working capital ratio. It measures a company's ability to pay off short-term liabilities with current assets. These current assets are assets that can be converted into cash within 1 year. So as you can see, the formula is current ratio is equals to current assets and current liabilities. So there are answers that if the current ratio equals to 1.5 or to 3, it means that the company has a healthy business or healthy business performance. And if the result is lesser than 1, there have problems term obligations. And if the result is greater than 3, it's too high. It may be insufficiently using its current assets. So next one, let's proceed to the asset test ratio or the quick ratio. It is also called as quick ratio. It measures a company's ability to pay off short-term liabilities with quick assets. These assets are assets that can be converted into cash within 90 days. So lahi sila sa current ratio. Current ratio is current assets ang use, which is converted pwede ma-convert ang assets into cash within 1 year. And ang asset test ratio is within 90 days. So, as you can see on the slide, the asset test ratio is equals to current asset less inventories and divided to current liabilities. Next is the receivable turnover. It is also called as accounts receivable turnover ratio. It quantifies a company's effectiveness in collecting its receivables or money owed by the clients. So, ang iyahang formula is net credit sales over average accounts receivable. So, net credit sales, mo nang net credit sales it's because we are talking about receivable. Pag receivable, it means inutang siya sa customers. So, naman yun na, gross sales is i-deduct na to ang sales, discount, sales returns, dayon makaderive ta og net sales. Ang net sales, i-deduct nimo sa cash sales para makaderive ta sa net credit sales. Dayon, net credit sales over average accounts receivable. Ang average account receivable is computed as beginning receivable plus ending receivable over divided by 2. So ang result, it can be pwede siya kung high ang turnover, collecting of accounts is receivable, company operates on cash basis. So if high ang receivable turnover niya, kay ang pasabutan na ang company kay cash basis, of which ang majority sa ilang business transaction is gipalit sa customer through cash, wala giutang. So if low ang receivable turnover, it means poor collection process. Bali, most of the sales kay inutang plus wala pa gyud anang lisod pa jud kayo i-collect. So last is the inventory turnover. How many times a company has sold and replaced the inventory during a given period. So the formula is inventory turnover over I equals to sales over average inventory. Average inventory is computed as beginning inventory plus ending inventory divided by 2. Then next is let's go to evaluating profitability. So evaluating profitability or the profitability ratios. These ratios convey how well a company can generate profits from its operation. The first one is the rate of return on net sales or the ROS, also known as return on sales. So it measures how efficiently a company turns sales into profits. So next slide, please, evaluating Next is ang return on sales, ang yung formula is net income over net sales. Next is rate of return on total assets, or also known as ROA, return on assets ratio. It measures how efficiently a company is using its asset to generate profit. Its formula, as you can see, net income divided by the total assets of the company. Last, for the profitability ratios, is the rate of return on owner's equity ratio, or ROE, return on equity ratio. It measures how efficiently a company is using its equity to generate profit. The formula is net income divided by the shareholders' equity. And the last is, next slide please, solvency ratio. There are there are specified two topics. The debt ratio, it measures the relative amount of a company's assets that are provided from debt. So debt ratio, the liabilities divided by the total assets. And last is the TIE ratio, or the time interest earned ratio. It measures of a company's ability to meet its debt obligation is based on its current income. So ang iyang formula is EBIT over or divided to total interest payable on bonds and other debt. EBIT means earnings before interest and taxes. So kani siya is mo ni siya ang ratio analysis. Iyahang common nga purpose is to help the decision makers, or kanabitang mga direct influence sa performance sa companies, such as shareholders and investors. Kay kung sa makita nila kung nindot og performance ang company, pwede magpadayon sila invest or magpadayon sila og palit og stocks. But pwede po niya siya himuong techniques or means para to determine financial statement fraud. Any changes in the financial statement ratios from one year to the next year and over a period of time should make sense. It's because there are two measurements para makabalo ang usa ka company unsay nahitabo or performance. Pwede ka mag-compare sa financial statements sa imong same industry nga company, or on the other hand, pwede po nimo i-compare ang imuhang business performance through the year or yearly or annually para makita nimo unsay dagan, nag-fluctuate ba ang inyuhang profit, ni increase ba or ni decrease, and so that dira mahibaw-an nimo na ay mga suspicious na nahitabo or misappropriation of asset na nahitabo. Because kanang mag-compare man gud ka og ratio sa kanang financial statements, mag-base ka sa industry averages. Panalitan ug ang imuhang business is manufacturing. Based sa ako ang na-research, pwede ra nimo siya ma-research sa Google unsay industry average sa gross profit panalitan sa manufacturing. For example, 10% ang industry averages. Ug sa year 1 siya nga financial statement, ang iyahang gross profit is na-achieve niya ang 10% or mas dola ng 10%, okay pa. Or for example, i-compare nimo siya sa pagka year 2, then panalitan ang performance niya sa year 2 is greater than the 10% industry average. Pwede na mag-warning ang company unsay nahitabo, nganong ning kalit og taas ang sales, nganong ning kalit og taas ang receivable, nganong ning kalit og taas atong cash, ahaman ni napadulong. Dayon, reconsider relying on those financial statements. There are 4, the income statement and the balance sheet, changes in owner's equity, and cash flow. Red flags are warnings, such as katong giistorya before sa reporter, mahibaw-an, there are red flags nga makabalo ang management nga naay something wrong sa financial statement. There are sluggish sales, overstatement of profits na dayon. Like for example, ang case study last tong fake zones, wala na ko na-appeal siya sa wala na ako napil sa slide, fake zones company, dayon. Nasakpan ang ilahang company. Ilahang company is kanang mag-renovate, insurance, kanang mga nagaguba ng mga buildings sa mga fires and floods and such. Sa tinuod di ay 2% lang out of sa ilahang profit, 2% lang ato ang legit nga gikan sa ilahang trabaho. Kay ang 98% ato is mag-abang sila og mga buildings para inig mag-check ang auditors, mag-check ang auditors, mailad nila ang auditors. Tan mangabang sila kanang mga under construction nga business kay ilahang business is ano man kanang renovation, insurance sa mga building. So mangabang sila ng mga under construction para inig physical nga pag-check sa auditors, may bawaan nila nga most sa ilahang profit gikan ani nga activity. So, auto siya, it's a big help sa unsaon pag-detect o kanang financial statement fraud gamit ning ratio analysis. Okay, makabaluman sila through these percentages, makabaluman ka dili man jud sa ingon nga pananglitan year 1 1 million imuhang profit pagka year 2 ning 3 million. Kanang murag na something fishy siya. Okay, because naa may mga ratios nga naga-control. So, and that's all. Thank you. And for the two evaluating financial statements is to be reported by the next reporter. So that's all.
Okay, so I will be reporting the two evaluating. So first is the evaluating cash flow adequacy. So first is evaluating cash flow adequacy. So cash flow adequacy, it is a liquidity ratio that measures the ability to meet its short-term cash expenses. And it's another way to measure the short-term liquidity of a company is by calculating the cash flow liquidity ratio. Okay, so this ratio measures how well a company can handle its short-term debt. So first ratio is the cash flow liquidity ratio. So I have here the formula. So P ratio is equal to market value price per share or earnings per share. So I have an example here. So for example, the Island Corporation stock is currently trading at $50 a share and its earning per share for the year is $5. So I have here. So P ratio is 10. To get market value price per share is $50 divided by the earnings per share, which is $5. So the P ratio is 10. And the second is defensive internal revenue. To get the dividend yield is equal to dividend per share divided by current share price. So we will need to get the dividend per share, which is the annual dividend over number of shares. Okay, so after getting the dividend per share, so we will divide the dividend per share over current share price. So I have an example. Magnolia Bakery is a world-renowned bakery in New York City, known for its classic American baked goods and desserts. They are listed on a smaller stock exchange with a current market price per share of $25. In the previous year, Magnolia has paid out $20,000 in dividends with 1,000 outstanding shares. So first, let's get the dividend per share, so which is $20,000 annual dividend, and number of shares is 3,000, and the current share price is $20. So which is the number of shares is 1,000. Sorry. So and is equal to $20. So the dividend per share, which is $20 divided by $25, the current share price is equal to 80%. Okay, so next slide. So next is the evaluating market ratio. So evaluating market ratio is their ratios are employed by current and potential investors to determine whatever a company's shares are overpriced or underpriced. So first is the price or earnings ratio. So this ratio is the relationship between a company's stock price and earnings per share. So the formula is cash flow liquidity ratio is equal to cash plus cash equivalents plus marketable securities plus cash flow from operating activities divided by current liabilities. So here's an example. For example, the cash and cash equivalents is 150,000 plus marketable securities, which is $125,000 plus cash flow from operations, which is $350,000 over the total current liabilities, 45,000. So the result is 13.89. Next is the defensive internal revenue. So defensive internal revenue is a financial liquidity ratio that indicates how many days a company can operate without needing to tap into capital sources other than its current assets. So here is the formula of the defensive internal interval ratio. So current assets divided by daily cash expenses is equal to defensive internal ratio. But first, we will get the current asset, which we will add the cash plus marketable securities plus receivables. And then next is the daily cash expenses, which is the annual operating expenses minus non-cash charges divided by 365. Okay, so an example, suppose that a company currently has $40,000 in cash, 10,000 in accounts receivable, and 20,000 worth of available for sales securities. The company has $300,000 in annual operating expenses and incurs 25,000 in annual depreciation. What is its defensive interval revenue? So here is the formula. 40,000, which is the 40,000 plus 10,000 plus 20,000 is over 300,000 minus 25,000 over 365. So the result is 92.9. Okay, so next. Okay, so this one will be reported by Babaw.
Okay, good afternoon. Categories of fraud. Since there are so many kinds of fraud that I researched, this will be the most and interesting that I can find. There are 5 categories of fraud. First, financial statement fraud, asset misappropriation, theft of intellectual property and trade secrets, 4, healthcare, insurance, and banking, and the last will be the consumer fraud. First, financial statement fraud. So as you can see, financial statement fraud. It's talk about financially and is overstating of revenue, earnings, and assets, along with understanding liabilities or just plain concealing them, are the most common activities found with this type of fraud. Next would be the asset misappropriation. Asset misappropriation is some of the more common types of fraud fall into the category of asset misappropriation, which closely held business are most susceptible to. So, Miss Abarquez mentioned ganina na misappropriation is also known as a misuse or scheme of cash or something na property sa company nga gigamit or something gigamit sa mga employees nga sa dili maayo. Misappropriation of assets in organization and businesses happens more frequently than most employers believe. Many employees steal and use the company's property for their own personal gain, creating a breach of trust between them and the employer. Another term of misappropriation of asset is called insider fraud. This type of fraudulent activities are unpleasant part of managing a business. So we should aware this kind of fraud. And next is theft of intellectual property and trade secrets. As our world becomes increasingly driven by information and technology, an increase in the theft of intellectual property and trade secrets is on the rise. When we say thief of intellectual property and trade secrets, when we say thief is sa Bisaya, kay something mangawat or stole something nga dili atoa. So when we say intellectual property, it's all about ideas, plans, methods, technologies, or any sensitive information from all types of industries, including manufacturers, financial service institution, and the computer industry. So kaning mga mangawat sa mustol og lahi-lahi mga ideas ba nga kana bitong gamiton nila sa para i-compete into other kuan ganang kawato na lang ni nga idea para i-compete ani ana mon. Not all the time nga ang kawaton or ang fraud is about money. Usahay ing ani sa mga idea. And trade secrets are planned for a higher speed computer design and ana something in ana. It also intellectual property thief is defined as a thief of material that is copyrighted. Napay mga copyright mga publisher, composer or other person who creates a work kay ilaha pong gina copyright or inana something. It is part of thief. It is part of thief of intellectual property and trade secrets. So let's go to healthcare, insurance, and banking. Healthcare, insurance, and banking are all industries that have billions of dollars flowing through their system. So, na mga company about sa mga healthcare nga dagko na silag mga income nga naga-flow sa ilahang mga system and ani nga situation murag maka-heart siya sa mata sa mga employees who katong mga hilig og fraud ba na kanang more on personal interest something ana. So this kind of fraud murag sa ilahang kuan, this will be the prime targets sa ilahang ani nga sulod sa healthcare, insurance, and banking. So daghan kay mga it is exist sa panahon gani karon murag maklaro na nato nga healthcare, insurance, and banking is kanang kumbaga gina-corrupt or gina-fraud sa company nga na ay mga employees nga they are kanang konsabo kumbaga kay aron lang kay mas interesting magod ni healthcare because of the billions nga moabot sa ilaha. So I will not mention ikat sa i-mention na lang siguro na for example as what I heard, I'm not sure pero nadunggan lang nako nga ang PhilHealth kuno sa Philippines is ginasakyan. And I think it is one of the healthcare, insurance, and banking fraud because ang uban hospitals and government are mag-usa about sa PhilHealth kay we know that PhilHealth is dako kay og budget sa mga people. Ang mga people kay sometimes when we say COVID gani kay kuan kining dako kayo og nagko kaayo og mga bills, right? Then aha nila na ginakuha diba sa PhilHealth na ay mga PhilHealth nga ginadeductionan ana. So ang PhilHealth will be the most nga dako og party ani nga ana nga company. So murag mo ka heart jud siya sa mga employees nga nagtrabaho ana. And that would be the healthcare, insurance, and banking. Let's go to consumer fraud. Consumer fraud is individuals targeted through cons, bogus telemarketing, email, Ponzi schemes, phishing, IDT, and other schemes are all victims of consumer fraud. So when we say consumer fraud, kay kuan kining when we say kuan naman gud karon kining high-tech ba high-tech. So consumer fraud occurs when a person suffers from a financial or personal loss. The fraud can involve the use of deceptive, unfair, misleading, or false business practices. The fraudster typically target senior citizens and college students, but all consumers are at risk of fraud. So, money fraud na gingamitan nila og mga bugos something in ana. Okay, since we already know about categories of fraud, let's talk about person who commit fraud or financial management, extreme wealth, personal interest, or environments that reflect it can be unethical behavior. Not surprisingly, financial secret fraud is usually committed by those in senior positions, such as upper-level management, CEOs, CFOs, COOs, and others. These are the people who stand to gain from a healthy bottom line. No, since we say, ala, kuan na sila mag-fraud ay ng mga ana nga kind of tao kanang kuan naman ni sila kanang mga hire naman taay ni sila dagko nagsweldo something ana. So when kuan man good sa company naman good naga-flow man jud sa diba gi-compute na ninyo ang sa last nga mga previous nga ratio about sa company. So lahi ra jud ang kanang sweldo sa mga employees like CEO, CFOs, and owners, ani. Lahi ra jud. So, kuan, this is a big opportunity for them kay sila may nag-negotiate, sila nakakita ani nga kuan, naka-foresee sila ani nga kind of system nga naa ang company. So, it's a big opportunity for them nga makakuha jud sila interest about commit of fraud. And that's all.
Overview of largest fraudulent financial reporting fraud is intentional misrepresentation of a firm's financial statement with the aim to give investors a mistaken impression about the firm's about performance and profitability. So, and can have a significant consequences for the organization and for the public confidence in the capital market. Example for the financial reporting fraud is Enron and MCI Communication. Enron is the one of the biggest or largest corporate fraud. Enron Corporation was an American energy, commodities, and services company based in Houston, Texas. It was founded in 1985 as a merger between Houston Natural Gas and Internorth, both relatively small regional companies. So before this bankruptcy, on December 3, 2001, Enron employed approximately 29,000 staff and was a major electricity, natural gas, communication, and pulp and paper company with claimed revenues of nearly 101 billion during 2000. So, Enron Corporation has a revenue of $100 billion $8. Revenue ay $100,789,000 ang revenue niya. Ang net income niya is $979 million, and the total of assets is $67,503 billion. Another one of the largest fraudulent financial reporting fraud is MCI Communication Corporation was a telecommunications company headquartered in Washington. That was at one point the second largest long-distance provider in the United States. MCI was founded as Microwave Communications Incorporation on October 3. The release stations will be used to interface limited range two-way radios used by truckers along the US Route 16 or by the barges on the Illinois Waterway. MCI was founded Microwave Communication Incorporation. The initial business was planned for the company to build a series of microwave radio stations in Chicago. The relay stations will then be used to interface with limited range tow-way radios used by truckers in US. The long-distance communication service will then be marketed to shipping companies that were too small to build their own private relay system. And the last is financial statement fraud strategies for detection and prevention. Financial statement fraud is the deliberate misrepresentation of the financial condition of an enterprise accomplished through the intentional misstatement or omission of amounts or disclosure in the financial statements to deceive financial users. So, description, practical samples, sample reports, best practices, and recommendation to help you detect and prevent financial statement fraud. So we have 10 strategies for detection and prevention. So nabutang sa slide. Number one is segregate accounting duties. So because of their size, many small businesses have one person that always handles bookkeeping functions such as client receivables, processing clients' payments, paying invoices, or managing petty cash and recording these functions in their accounting system. So this makes it easy for cases of fraud to go unnoticed. Businesses should have at least two persons handling this function, interchangeable, keep the handling of cash and accounting totally separate, or have the function performed through a relationship with accounting firm. So dapat ang number one case, segregate accounting duties, dapat i-segregate sa mga duties nga risba kanang nagkuan sa clients or sa unsa pa lang nga naa sa accounting. Next, number 2, know your employees. While every business strives to hire honest employees and having a formal hiring routine, even a small business, so dapat kuan mga employees nimo makabalo kag unsa ilang mga batasan, honest ba sila or dili. Number 3, routine internal controls. Even small businesses need to create and maintain internal controls that can prevent or detect fraud. So dapat maay maintenance. Number 4, scrutinize business bank's account. With online banking options, it's easy to view account activity and statement whenever it's convenient, and business management should do this frequently to make sure that paper-based statements in the office have not been manipulated. Number 5 and number 4 pa. The key items to look for are missing or out of orders checks, unknown payment recipients, and checks that were signed over a third party instead of deposited in a business account. Simply letting staff know that reviewing check activity is part of the accounting review practice can help prevent fraud. Number 5, audit the books regularly. Dapat i-audit mo ang dapat mag-audit ka taga-adlaw sa mga cash, funds, product returns, inventory management, o ang accounting function. So additionally, occasional non-scheduled audits can also help detect fraud and high-risk critical business areas. Number 6, train employees to prevent fraud. Employees in fraud areas of the business should know the warning signs of fraud, prevention skills, and how to report suspicious behavior or actions by co-workers and customers. Publishing on anonymous reporting system or practice can also set their mind at ease about letting their bosses know about a fellow co-worker. Number 7, protect credit card information. Credit card fraud is the headline so often that some people may have become numb by the news. But the businesses of all sizes, even the smallest home-based endeavor, should start by firmly separating business and personal accounting. Number 8, know your business partners. Before getting into a business relationship with another business or individual that requires some level of trust, such as sending them an invoice after delivery and product or service. So before ka nga magkuhan og partner, dapat makabalo ka kuan sa ihang background kung makaya ba niya. Number 9, check into every case. If you've set up fraud prevent steps and reporting procedures, but you don't follow through by looking into reports or suspicions, then you're defeating your own security in order to reinforce the business policy of no tolerance for unethical behavior. Each case should be looked at regardless of size. So the last is get expert help. If a business implemented fraud prevention steps and the numbers still aren't adding up, or when there are larger legal implications, and may be prudent to hire a professional accountant to come in and perform more extensive review and audit of the business books and control processes. So the last one is financial statement fraud continues to be a major challenge for organizations worldwide. Financial statement fraud prevention is a superior reference providing you with up-to-date understanding of financial statement fraud, including its deterrence, prevention, and early detection. So you have to find this a clear description of roles and responsibilities of all those involved in corporate governance and the financial reporting process to improve quality, reliability,
Wala.
and transparency of financial information. So the second is you find these sample reports, examples, and later documents that promote a real-world understanding of incentives, opportunities, and rationalizations.